So friends, in the beginning of section 18, I told you that this section has to be read with the three rules. Rule number 40, 41 and 44. In the previous video, we have already discussed section 18 in detail. And that is availing input tax credit in special circumstances. And especially we talked about when a person is registered or a person is under the composition scheme and he comes out of composition scheme, or exemption ceases, or there is a transfer, etc., etc. All that thing we have talked about. Now coming to rule number 40. In this we are referring about how much credit can be availed and what is the system or procedure for availing the credit. Mainly, it is talking about capital goods. For capital goods, credit is available under section 18 subsection 1 clause C and D. And in the subsection 6, we are talking about reduction also, or rather removal of capital goods. So in capital goods, this is availing input tax credit. This is section 18 subsection 1 clause C and clause D. Right? Then we have removal of capital goods. This is covered under section 18 subsection 6. In both the cases, the amount of the input tax credit is required to be reduced. In this case, since the capital goods have already been used in business for certain period of time, therefore now the amount of the credit which is available will be reduced. In this case, there is a reversal, but the reversal is also reduced. So in this case, certain portion will be retained by the assessee and some portion has to be reversed. In either situation, here reduction of input tax credit which can be availed, is reduced by 5% for every quarter or part. And this begins with since date of invoice or any other document on the basis of which the input tax credit is intended to be availed. So this will be reduced at the rate of 5% for availing. Under section 18 subsection 6, there is reversal. So reversal of credit shall be reduced at the rate of 5% for every quarter or part thereof. Right? So this is about the capital goods. And then description of capital goods as well as inputs. Now these inputs referred under section 18(1) clause A to clause D. All these are required to be furnished by way of declaration and this declaration is form number GST ITC 01. When the declaration is to be filed, this is within 30 days since becoming eligible for input tax credit. So this information, description of the capital goods but amount is reduced this way, and the information of inputs as required under section 18 subsection 1 clause A, B, C, D, and the specific date is also given as on that date. The description has to be furnished to the department by way of filing the form number GST ITC 01, and that form should be filed within 30 days since the person becomes eligible to avail the input tax credit. And now last thing, if amount of ITC claimed exceeds rupees 2 lakhs, so you have to underline a specific word, exceeds 2 lakhs. So if it is exactly 2 lakhs, this provision will not be applicable. If it is more than 2 lakhs, provision is applicable. So the amount of input tax credit claimed exceeds rupees 2 lakhs, declarations shall be certified. Declaration shall be certified by either chartered accountant or cost accountant, and of course they have to be practicing cost accountant or chartered accountant. So friends, in nutshell, this is rule number 40. So this is related to section 18 subsection 1 as well as subsection 6. This is availing the credit and removal. Credit is available in as far as inputs are concerned, whatever amount of duty is there, and as far as removal is concerned, so in case of removal, if it is inputs are being removed, then whatever amount of credit is there, that is required to be reversed. But in case of the removal of the capital goods, the amount of the tax which is required to be reversed will be reduced by a certain percentage. So when we say reduced, means what is retained, that is available to the assessee. So this is rule number 40, right? I hope you have already taken the note, and now we move to rule number 41. So now rule 41 is relevant for a specific situation, and that is covered in section 18 subsection 3, and that is sale, merger, amalgamation, demerger, and those are the transactions covered herein. So here we have rule number 41, and this is related to section 18 subsection 3, right? This is talking about transfer, sale, merger, demerger, amalgamation. Now these are the situations in which the unutilized credit in the ledger of the transferor can be transferred to the credit ledger of the transferee, but subject to fulfillment of the conditions. So here we have certain responsibility on the part of transferor and certain responsibility on the part of transferee. And if both fulfill the conditions, then unutilized credit will be transferred to the credit ledger of transferee. So first of all, what shall be done by the transferor and what is to be done by the transferee? For transfer of unutilized credit. Now, as far as this transfer is concerned, this is furnish details of transaction in form number ITC02. Now this form is having not only the description of the transaction but also complete detail of the goods or assets which are being transferred. And when this is done, at the same time make a request for transfer of unutilized input tax credit to the transferee. So the process has to be initiated by the transferor, that transfer unutilized credit to the transferee. Here we have a note that it is not the entire amount, and this note is relevant only in case of demerger. In case of demerger, what happens in case of demerger? One existing unit is divided into more than one unit. The amount of input tax credit, the amount of input tax credit to be transferred to transferee shall be in the ratio of value of assets of the transferee. So in case of demerger, one existing unit has been divided into more than one unit. So in that situation, it is not the entire amount of the credit which will be transferred to the transferee, but it will be based on the value of assets which are being transferred to the transferee. So this is the responsibility on the part of transferor to ensure that unutilized credit is transferred to the transferee. Now what the transferee has to do, this is obtain a certificate from practicing CA or CMA, that is cost accountant, that the transaction has been given effect with transfer of liabilities. So that was the condition under section 18, that if all the liabilities of the business are also transferred, then unutilized credit will be transferred. So this is here, the first of all, get a certificate from practicing CA or CS, that in the given transaction, so transaction may be either transfer or sale or merger, demerger, amalgamation, whatever may be. So first of all, he has to obtain a certificate from chartered accountant or cost accountant that the liabilities of the business have also been transferred. Then this is to be filed, and then accept the details furnished by transferor in ITC 02. So this declaration is filed online, this acceptance will also be online. Then all the capital goods and inputs transferred by transferor shall be duly accounted in books of account. So these are the books of account of the transferee. So first is transferor furnishes the details, makes a request that this amount be transferred. Then the transferee should accept all. Transferee should first of all obtain a certificate, then accept all the things, whatever is furnished by the transfer in ITC 02, and the books, all the goods which are transferred, those are accounted. And when this happens, the amount of unutilized credit will be transferred to the credit ledger of the transferee. So the last thing is unutilized credit of transferor gets credited to ITC ledger of transferee. Okay, so in this chart, this is the entire rule number 41. I have given the who has to do what. So section 18 subsection 3 has to be read with rule number 41, and this is related to either sale or transfer otherwise, or merger or demerger or amalgamation. In these situations, if the liabilities of the business are also transferred, then unutilized credit in the credit ledger of the transferor will be transferred to the transferee, provided all this procedure is completed. So first is transferor has to do something, then transferee has to do something, and then the unutilized credit will be transferred to the transferee. Okay, so this is rule number 41. Now the last rule for the purpose of section 18 is rule number 44. Now rule number 44, this becomes relevant in two different situations, and those situations are covered in section 18 as well as section 29. So here we come to rule number 44, right? So as I said, this is applicable in two situations. One is referred under section 18 subsection 4, and another situation is under section 29 subsection 5. In section 18.4, again two things are covered, that is opting for composition scheme, opting for composition scheme, and another situation is taxable supplies becoming wholly exempt. So in these situations, when there is no tax liability, the question of credit is not there. And section 29.5, this is cancellation of registration. Cancellation of registration. Why it is cancelled, that is a different story, but whenever there is a cancellation of registration, the input tax credit is required to be reversed. So this title of section 44, this is saying reversal of input tax credit under special circumstances. So which are those special circumstances? Those are already listed above, that is section 18.4 and 29.5. 18.4, a person who is paying taxes, normally he is opting for the composition scheme, so he will have to make the reversal of credit. Another situation, the taxable supplies of the person become wholly exempt. So you will have to underline this word, the goods become wholly exempt. So not only exemption, because exemption can be partial as well, but when it becomes wholly exempt, there is no more entitlement to retain the amount of input tax credit. And 29.5, registration is cancelled. So whatever credit is there, that will have to be reversed in respect of the goods which are in stock. Okay, so this is the background of rule number 44. Now what it is saying is, how much amount is required to be reversed, right? You can add further, you can write another once again, rule number 44, this is saying amount of input tax credit required to be reversed. In relation to inputs and in relation to capital goods. First thing is, whatever we are going to talk about, there is separate calculation for central and state tax. CGST, IGST, SGST, UGST, all are required to be calculated separately, and the same thing applies for capital goods also, right? Now in this case, this is amount is based on quantity of inputs in stock, and that may be as input, or those are contained in semi-finished goods, or those are contained in finished goods, right? Now this is, again you can divide it in two parts. If you have invoices, corresponding invoices on the basis of which credit was taken, and if there are no invoices, then how much amount is to be reversed. So this is based on amount in invoice, and this is based on prevailing market value on the day of event. And this event is either under section 18.4 or under section 29.5. So as on that day, what is the prevailing market price of those goods? Based on that, the amount of tax will be calculated by way of reverse calculation. So this is one part, how the amount of the input credit which is required to be reversed is to be calculated. So first thing is, calculation has to be done separately for central tax as well as state tax, and it is based on the quantity which is available in stock as on the day on which event takes place. And if we have the invoices available, then calculation is to be done based on those invoices, and if invoices are not there, then we will take the prevailing market price of those inputs on the day of event, and event is as per section 18.4 or 29.5. Right? So this I am writing once again little clearly. This is 29.5. Now, in relation to capital goods, first we have already talked about the separate calculation is to be done in respect of central tax as well as state tax, and for the calculation reversal is to be done for remaining useful life of capital goods, and for that purpose useful life is taken as 5 years. So effectively it is total amount of ITC divided by 60. This is the amount of the input credit which is required to be reversed for per month basis. So this per month basis into period of useful life remaining. This much amount has to be reversed in respect of capital goods, and for both, for capital goods as well as inputs, this amount is to be added with output liability of registered person. So friend, this is rule number 44, right? Now when this is done, a return has to be filed. If the registration has not been cancelled, in that case form number ITC 03 has to be filed, and if the registration is cancelled, then GSTR 10 has to be filed. In that case, this amount has to be reflected in ITC 03 or GSTR 10. So when the registration has been cancelled, then GSTR 10, and if there is a case of 18.4, in that case ITC 03 that has to be furnished. Okay, this is entire rule number 44. So this brings us to the end of the rules which are connected with section number 18. In the next video, we'll talk about section 19. Till then, have a good time.